Hello everybody, Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, bringing you another 2-minute drill subscriber request series, Lessons in Valuation. Today I'm going to look at a Canadian company called Rogers Communications, and I'm going to do some interesting analysis here by looking at FastGraphs and try to illustrate how you can very easily be misled by certain statistics unless you really understand the statistics you're looking at. As they say, statistics don't lie, but statisticians are often darn liars. So let's go ahead and look at Rogers Communication. This is a yield stock. This is an income investment, if you will. So looking at the fast graphs, first off, I'm going to take price off the graph. I want you to notice a couple of things that just immediately come into mind. There was a huge growth spurt coming back here as you look at the company back in all the way through, let's say 2000, maybe up to 2013, where it grew really fast at over 43%. But that was comprised of 130% growth, 2,000% growth, 67% growth. So these growth rates are, I think, ridiculously and certainly unsustainable. If you look at more recent years, just from like 2019 to forward, using your fast graph tool, it's growing at less than 2%, which is more customary for a company in the wireless telecommunication services. So again, you want to call out some of these aberrant years and look at the company from a practical point of view in recent years. Now, let's talk about the positives. The company is trading at a blended PE of 7. So if I put price on the graph, weekly closing stock prices on the graph, you can see that the market has typically traded at between 14 and 17% or 17 times earnings. Occasionally they got into the 19 and 20 multiples, but it pretty much traded this when it was doing this, and I think it was primarily the yield. The dividend has been steady, but not necessarily growing. They froze the dividend from 2015 to 2018. They froze it again since then, so we don't see a lot of dividend growth here, but we do see high yield, 5.7% currently. It's a BBB minus company. It has a lot of debt, but again, that's not necessarily unusual for a wireless telecommunications company. Okay, now looking to the future, if I look at forecasting, the analysts are expecting about 2% growth. It's reasonably well followed. Analysts have been lowering their estimates, I might add, over the last 6 months, and that could partially explain why the stock has gotten so cheap. But if this stock just traded at a 12 multiple, and we're using the Graham-Dodd formula here, and we're drawing the fair value line at a 12 multiple, it's actually 11.93. So you can see if it moves back from a PE of 7, that would be PE expansion plus dividend yield. You could double your money this year, more than double it. You could average over 40% through 2026, and you could average almost 28%, 27.6% through fiscal year 2027. So this could be a very interesting buy at today's prices. Now, as always, further due diligence is required. I don't know this company really well. I'm just looking at what I see on what the company has achieved as an operating business, especially in more recent years. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. Hope you enjoyed this video. If you did, ring the bell. Give me a like, subscribe to our YouTube channel, and subscribe to FastGraphs. You can see how it's a marvelous tool to help you make more rational decisions. This particular option was one that was extremely inexpensive today, and there could be good reasons for it. But all in all, it looks like a great income vehicle, and it could generate very strong returns if we get a kind of reversion to the mean. If the price moves back to even just a 10 or 12 multiple, you can make a lot of money in this stock over the next 2 to 3 years. Thanks for watching, and check in again soon.